Real estate is and has always been the tool that has created the most millionaires through the ages, but recently we've seen that the price of real estate has burned down and reached some all-time high, which means that many young families and investors don't even have the possibility to buy their first property. So what if I told you that there was an easier way for you to invest in real estate without having to invest hundreds of thousands of dollars upfront? And the answer to this question is 4 letters: REIT. So today you'll find the best Canadian real estate investment trust that you can buy right now if you're looking for great capital appreciation over time and some great passive income from the dividends. Without further ado, let's take a look at my pick number 1. For the first company on my list, I've decided to include the largest REIT in Canada, which is the Canadian Apartment Properties with the ticker CAR.UN. This multifamily oriented REIT currently worth over $8 billion and it has over 50,000 residential units, which include 44,000 residential suites and 32 manufactured home communities. And in terms of the geographic diversification of those 51,000 units, you can find that the majority of them are located in Canada and in the Netherlands. And so you can understand that their business model is acting on buying different properties that are considered as some residential properties, including different apartments, townhouse, and land lease communities that have great locations in major urban sectors. The big pros and advantage of this kind of REIT is that despite times of high inflation and recession, people will keep having needs to live somewhere, and by having over 51,000 units, you can understand that this REIT has a major impact in the global life of these people. And compared to the classical office REIT, which have a lot of working spaces and which will obviously get a lot impact by the teleworking, well, this kind of REIT is there to stay. Especially over here in Canada, where we've seen that the price of houses have exploded throughout the pandemic and where the interest rate is through the roof. It obviously means that many young Canadians don't even have the possibility anymore to buy a house, and they will obviously need to rent somewhere. And the situation is far from being over, since we know that the immigration will continue to increase over the next couple of years, where after 2025 we are expected to see over 500,000 of new Canadians every year. But on the other side, obviously companies like CapREIT will continue to be able to buy and purchase great real estate properties, and so they will continue to enjoy the benefits of this high immigration. And talking about the income that this kind of company has been able to generate over the last couple of years, we won't be using the same financial metrics as we usually do. For example, to evaluate if the company is currently over or undervalued, we won't be using the classical price to earnings ratio, but instead we'll be using the price to FFO ratio. The FFO, or the funds from the operation, is a basic measure that is showing with you what has been the total cash generated from the real estate activities. And so with the current price to FFO ratio of about 17, this company is currently quite undervalued at the moment. And knowing the 90% rule of REITs, which is showing that REITs must distribute over 90% of their total earnings to their different shareholders in the form of dividend, well, it obviously means that we won't be able to use the classical payout ratio to evaluate if the dividend of this business is quite sustainable on the long term, and in fact we'll be using the FFO payout ratio. And in the case of CapREIT, with an FFO payout ratio of about 63%, you can see that they still have a lot of room for growth in the future. But in their case, even if they have the possibility to eventually increase their dividends, you can see that since 2021 they haven't been able to increase it, notably because of the rise of the interest rate that will massively impact all the debt that these kind of companies have. Nevertheless, even if this company is giving only 3% of monthly dividends to their shareholders, which is slightly less than the average REIT, well, since the beginning of the year it has been able to provide some excellent capital appreciation of over 30%. And at the same time, their net operating income, known as the NOI, has been on the right track since the beginning of the year, where in the first quarter of 2023 it has grew of over 7% compared to the same quarter but in 2022. And now the second real estate investment trust on my list is Granite with the ticker GRT.UN. Under par, this Canadian business is considered as an industrial REIT, which is buying, operating, and managing different warehouse and logistic facilities in North America and in Europe. Indeed, with an incredible overall occupancy rate of about 99%, Granite has over 152 different real estate properties in Canada, the US, Germany, the Netherlands, and Austria. And obviously, what is interesting about this kind of REIT is that they have an excellent geographical diversification, but not only that, they have some great quality tenants. For example, they have great tenants such as Walmart, Amazon, and Home Depot. And the big pros of this kind of ETF, just like CapREIT, is that it isn't going anywhere anytime soon. In fact, with the project growth of e-commerce over the next couple of decades, this kind of REIT might see a lot of growth on their part as well. Let's take the example of Amazon. This American business is the largest e-commerce business in the world, and in fact, people will want to buy online, but the kind of companies such as Amazon will need to store their different products somewhere, and it's where real estate investment trust properties such as Granite will be very interesting for them. So now that we've made a quick overlook of what is the business model of this REIT, let's take a look at the different fundamental metrics about it. First of all, compared to CapREIT, Granite currently has a higher dividend yield of about 4% that has been growing over the last 4 years. And at the same time, on their side, they also have an excellent FFO payout ratio of about 64% at the moment, which is showing that they still have some room for growth in the future. And not only that, but on their side, at the moment, they currently have a lower price to FFO ratio of about 11 at the moment, which is showing that it is more undervalued than CapREIT. And over the last quarter, you can see that their net operating income has been growing of over 18% over the last year, which is some growth that is even more impressive compared to the Canadian apartment properties. However, whereas this other Canadian REIT has gained over 30% of value since the beginning of the year, you can see that this one has gained about 2 times less value with some gain of about 15%, which is showing that the Canadian apartment properties is focused more on growth compared to Granite, which is more focused on the dividend payments. So personally, I believe that these two Canadian REITs can be very interesting to add in your portfolio depending on what are your different objectives, and they both give you great complementary advantages of owning different real estate properties, where the Canadian apartment properties will give you the benefits of the future growth in the population by owning over 50,000 residential units, and where you can take advantage of the future growth of the e-commerce by owning the Granite REIT. But on your side, if you're looking for a wider variety of great real estate investment trust companies to buy right now, well, check out the video that's gonna be right over here, and I will see you soon. Peace!